So here's the deal. The data is in, and it indicates the global economy has officially fractured. I mean, while you've got Wall Street in this blind race to S&P 7,500, a massive supply shock has just paralyzed the Strait of Hormuz. And believe me, this is creating an absolute nightmare scenario for central banks.
This right here, this is the number that really matters. 10 million barrels per day. That's the amount of oil production that Gulf countries have been forced to slash because of the blockade. Let's be really clear about what this means. We are witnessing the single largest energy supply disruption in modern history.
And look, that's not me being dramatic. That's a direct quote from the head of the International Energy Agency. When you're facing a crisis of this magnitude, really the only question that matters is how do you navigate it? So in this explainer, we're going to break down the exact institutional strategies for surviving the 2026 stagflationary shock.
Okay, before we dive deeper, our standard disclaimer. The data is showing some incredibly complex geopolitical shifts and, frankly, extremely high volatility. So just a reminder, the information in this explainer is for educational purposes only. It is not investment advice.
You know, at the very heart of this crisis is something JP Morgan is calling a deeply entrenched, K-shaped global expansion. Now, what does that mean? Well, think of it like this. The economy splits and goes in two completely different directions. One part shoots straight up while the other just collapses. It's a story of profound divergence, with different parts of the world on totally opposite economic paths.
And the scale of this divide, it's just staggering. On one side, you have the U.S. Goldman Sachs data confirms it's outperforming with 2.6% growth, and that's all being fueled by this massive AI capital expenditure boom and a kind of stealth quantitative easing. But then on the other side, you have Europe facing a brutal stagflationary shock. We're talking growth at a measly 1.3%, getting absolutely crushed by crippling LNG prices. This puts the European Central Bank in an impossible trap, being forced to hike interest rates right into the teeth of a severe industrial recession.
This image just perfectly illustrates the U.S. story, right? AI isn't just another sector anymore. It's become the engine carrying the entire economy. It's shouldering the weight of global inflation, all that debt, and sluggish growth everywhere else. I mean, the capital spending from just a handful of tech giants, it now accounts for nearly a quarter of all U.S. market capex. It's incredible.
Now, the big institutions, they see this happening. They are repositioning billions of dollars right now based on this exact central bank divergence and the weaponization of global trade. So if you want to stay ahead of what is shaping up to be a massive wealth transfer, make sure you're subscribed so you don't miss our real-time updates.
So what's actually causing all this chaos? Let's get to the geopolitical trigger. This blockade in the Strait of Hormuz, this isn't just some random supply disruption. No, the analysis shows this is a deliberate geopolitical filter. It's the ultimate weaponization of logistics.
Just look at this breakdown. It's like Iran has created a two-tier system, a geopolitical toll road. So vessels from nations it considers friendly, we're talking China, Russia, and India, they get safe passage, no problem. Meanwhile, any ships linked to the US, Israel, and their allies, completely blocked. This basically turns a shipping lane into a geopolitical sorting hat, and it creates a massive competitive advantage for Eastern manufacturing.
And this filtering strategy, well, it explains precisely why the U.S. has made such an aggressive and frankly surprising move in Venezuela. Under what some analysts are calling a modern Monroe Doctrine, the U.S. isn't trying to police the world anymore. Instead, it's securing its own hemisphere, taking direct control of Venezuelan oil to insulate itself from that shock in the Middle East. It's a ruthless move, but from a strategic standpoint, it's kind of brilliant.
So as you can imagine, this supply shock has thrown global monetary policy into total disarray. It has essentially put the world's major central banks at war with each other, forcing them onto completely opposing paths because of circumstances way beyond their control.
The divergence here is just stark. The U.S. Federal Reserve has the luxury of energy independence, right? So it can afford to just hit pause, delay rate cuts, and focus on its own domestic inflation. The European Central Bank, it has no such luxury. It is completely trapped by severe imported energy inflation and a falling currency, forcing it to hike rates even as its economy grinds to a halt.
Okay, but here is the catastrophic risk that the market is just not pricing into the U.S. growth story. There's a major vulnerability hiding in plain sight, and it all revolves around the very engine we just talked about, AI. So first, just consider this boom. U.S. tech companies are on track to triple their annual capital investment to over $500 billion by 2026.
This unbelievable spending is exactly what's driving those massive earnings projections and that whole race to S&P 7500. It's a story of pure exponential growth.
But then you have this number, 5 years. You know what that is? That is the current crippling backlog just to connect new power generation to the U.S. grid. The AI data center expansion requires an astronomical amount of electricity, and our physical infrastructure, well, it simply can't keep up.
And this, right here, creates a potential domino effect. Think about it. If the U.S. power grids can't support the AI build-out, those massive 14% earnings growth projections for the S&P 500, they could completely collapse. Then, if oil stays high at $120 a barrel, a newly hawkish Fed could destroy the equity risk premium overnight, bringing this entire bull market to a sudden, screeching halt.
Okay, so that brings us to the payoff. How are the big institutions actually positioning for this incredibly complex environment where you've got deep stagflation in Europe and this potential power grid crisis in the US? Let's look at the specific asset classes designed to hedge against both of those threats.
Well, the data indicates two primary institutional hedges. First up, equal weight U.S. ETFs. This strategy helps deal with the massive concentration risk in just a few mega-cap tech stocks, giving you exposure to, the other 493 companies in the S&P 500. And second, physical gold. It really does remain the ultimate asymmetric hedge, an asset that can give you significant upside during a crisis with pretty limited downside. It's perfect for the rising stagflationary tide and the extreme geopolitical instability we've just laid out.
And all of this brings us to our final thought. This AI power grid crisis, it's really just getting started, but it also creates a truly historic investment opportunity. So the key question now is, which specific infrastructure stocks are best positioned to win what's shaping up to be the 2026 energy supercycle? We're going to break that down in our next deep dive explainer.